Welcome, everybody. This is Steve Gorin, and we are doing today the top 10 tactical and strategic issues for fiduciary income tax planning and returns. A little bit of housekeeping before we get into the substance. So this program is CLE certified, and CLE certificates will be sent once we verify attendance. If you're seeking CLE for this webinar, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in the verification form, including the login instructions sent to you. All CLE questions should go to cle-tc@thompsoncoburn.com. We will take questions during the webinar. So to ask a question, you need to open the chat box by clicking on the chat bubble in the top right-hand section of the screen. You must log in using the same email address you used to register for the webinar. The login is proof of attendance and supports our awarding CLE. If you need to leave the webinar, you should log out, and when you return, log back in. The webinar is 1 hour long, but if questions continue to come in after the end time, we'll remain online for an additional 5 to 10 minutes in order to continue to answer questions. The webinar is being recorded and will be available within 10 days at www.thompsoncoburn.com/TCLE. An electronic survey form will be sent shortly. We would appreciate you taking the time to fill out the form and return to us. So with me today is my partner, Laura Duncan. She and I work together on fiduciary income tax issues, as well as other estate planning matters. So welcome, Laura.
Thank you. Happy Valentine's Day to everyone.
Yeah, and we chose this day because we think everybody just loves taxes.
We're all feeling the love today.
So going to slide 2, today we're going to talk about 2017 tax law changes and about strategic income tax planning, and we'll get to as many as we can of the top 10 tips for fiduciary income tax preparers. So on slide 3, 2017 tax law changes. So first of all, we'll talk about Code Section 199A, which is a 20% deduction for qualified business income. Then we'll talk about changes in itemized deductions, and we'll talk about electing small business trusts. So slide 4. So for those who have pass-through entities, so S corporations or partnerships or sole proprietorships, there's a new deduction of 20% of your qualified business income. And there's a lot of rules that talk about how you compute the deduction, what kind of limitations there are, what income qualifies, et cetera. And we don't have time to go over all those details here, but we do have a recording from January 30th on strategic planning for business entities after 2017 tax reform, and that goes through whether people want to be a C Corp, whether they want to be a flow-through, what some of the long-term planning implications are. So if you open up your slide and click on that link, then that'll take you there, and you can listen to this free on-demand recording. So one of the issues with this 20% deduction for pass-through income is that if you're in the wrong kind of business, then you might not get the deduction unless your income is below certain taxable income thresholds. The deduction also is limited if you don't have enough wages or property that you're using in your business. And if your taxable income is below certain thresholds, then you don't have to apply this limitation based on wages and property. So for people who are married filing jointly, the threshold from that is $315,000 to $415,000. And for all other taxpayers, including trusts, the taxable income threshold is $157,500 to $2,500. So what happens is these ineligible service businesses that do not qualify will still get the deduction if their taxable income is below if their taxable income, for example, if you have a trust and taxable income is between $157,500 and $207,500, then the deduction gets phased out. And then beyond the $207,500, it gets eliminated. And then again, there's these wage limitations, and again, those get phased out over that range. So let's go on to the next slide. Okay. Grantor trusts are disregarded, and those items that qualify business income are attributed to their deemed owners. On the other hand, if you have a non-grantor trust, then what you do is you figure out the distributable net income. And what is that? For a trust, you figure out the taxable income, and then you're allowed to have a distribution deduction, so that when you make a distribution, the trust gets to deduct that, and the beneficiaries get a K-1 for that. So the distributable net income is is essentially roughly the same as your taxable income before taking that distribution deduction. So what you do is you figure out what your distributable net income is, and then you figure out who gets how much of that D&I. So to the extent it goes to the beneficiaries, they will get a pro rata share of this qualified business income that's eligible for the 20% deduction. They will get a pro rata share of the wages and property that are considered in figuring out this limitation that could reduce your deduction. So you split it up between the trust and beneficiaries, and then you apply the taxable income thresholds after you split this up. So if you have a business that is ordinarily ineligible and you can get your taxable income below that threshold, or at least within that range, then you can have some extra benefits. Or similarly, if you don't have enough wages or property used in your business, then you get your taxable income below the threshold, so then you can get the full benefit of those, or at least if it's within the range of partial benefit. So what you can consider doing is, if you give part of this S Corp or partnership, et cetera, to your kids, for example, then the kids can get taxable income thresholds and apply their own limits. And similarly, if you give it to a trust, that can happen. So let's suppose that you gave an interest in a partnership, and that generated $300,000 of qualified business income, and you gave that to a trust. So then the trust turns around and distributes half of its qualified business income to its beneficiaries. So then we'd have $150,000 left inside the trust and $150,000 owned by the beneficiaries, and each of the trust and the beneficiary can separately apply their taxable income thresholds to that. So there's some income shifting opportunities here. So some good planning for trusts when you have business interests.
So there's a few additional changes we wanted to highlight in the new 2017 tax law that have implications on trust that we wanted to highlight today. The first one on this slide relates to itemized deductions. So for tax years beginning on January 1 this year through 12/31/2025, miscellaneous itemized deductions are disallowed for those tax years, and that applies to trusts the same as individuals. The second bullet point relates to the new $10,000 limitation on state tax deductions. Again, similar to what individuals are limited to, trusts are also limited to that $10,000 state tax deduction. So as Steve was suggesting on the qualified business income, it may be possible for the individual beneficiaries to deduct up to $10,000 of their own state tax deduction, and for a non-grantor trust to also have a $10,000 deduction. So you could possibly get some additional benefit by that. On the next slide, slide 8, there's a couple changes to the electing small business trust, which we refer to as an ESBIT, which is a qualified S corporation shareholder, the SBET rules have been relaxed in regard to the fact that now non-resident aliens are permissible current beneficiaries of those trusts. And there's a new application for charitable contributions that flow through on a K-1 from an S corporation. For SBETs, they now apply the Code Section 170 rule, which is a rule that applies to individuals in terms of the deduction, rather than the 642 rules, which is a little more, the 170 rules are a little more favorable.
So now we have our first code word, which is change, because we just talked about changes according to the tax law. So write down the word change for your verification for your CLE.
So next slide, slide 9. This is just some of the topics we're going to cover on the section for strategic income tax planning. Who is best taxed on gross income, looking at the trust versus the beneficiary, effect of the Kiddie tax rules, who benefits from deductions. All of these items listed on here are things to consider in doing some strategic income tax planning. So the first bullet point on slide 10, we're talking about who is best taxed on gross income. So when we think about who's best taxed, we have to think about if we shift some of the income to the beneficiary, does that cause the beneficiary's AGI to increase and could cause them to lose some of their personal benefits on their tax returns? And some of those issues could be reduction on particular itemized deductions, such as medical deductions, casualty losses, et cetera. Potentially the phase out of the AMT exemption, the phase out of their personal exemption, and the net investment income tax, sometimes referred to as the NEAT tax, which becomes applicable when the beneficiary's income exceeds certain thresholds.
And you'll notice for the personal exemption it says 2026 plus. So the personal income exemption is repealed through the end of 2025 under tax reform.
What is applicable for 2017?
Right. Yes, that's a great point, Laura. So 2017, we worry about the phase out for the personal exemption. Then 2018 to 2025, we don't get it, so we're not worried about the phase out.
Then it comes back in.
And then it comes back in.
So slide 11, just continuing on this subject, also consider for the beneficiary, if the beneficiary has capital loss carryovers and other carryovers that could potentially offset income, it might be beneficial to move some of that trust income out to the beneficiaries. So moving on to slide 12, the effect of the Kiddie tax rules. For 2017, the Kiddie tax rules are the same as they've been in the past, where a child's unearned income is taxed at his or her parent's rate. And then starting in 2018 through 2025, they have changed those rules and simplified them in that all unearned income above a threshold, and in 2018 that threshold is $2,100, is now taxed at the brackets for trusts and estates. So basically that means if you have income, unearned income above $12,500, you're going to be taxed at 37%. So again, it sort of simplifies those rules, which could be complex when you have parents that have multiple children with unearned income, but could potentially cause higher tax rates to apply. The second bullet is just pointing out that there's no rule coordinating the net investment income tax rules. So it still may be beneficial to shift income to children because they may not be subject to the NEAT tax because they haven't met those thresholds for that tax to apply.
You know, before we move to the next slide, I neglected to mention what materials you have. You should have the slides and also supplemental materials, a PDF. And when you look, for example, on the slide 12, at the top of it, there's a parenthetical there. That refers to a section from the PDF. Now, the PDF that we have is an excerpt from a much longer paper, and when we prepared this, we froze all the cross-references, so you can't really click on them to move around. if you would like to get something where you can click on the references to move around it better, then you can email to get the full 1,600 plus pages of it. And there's the last slide of the presentation talks about that. But I just wanted to let you know what those parentheticals are for, where you can go to look at more information for what we're talking about. So slide 13, who benefits most from the deductions? So Laura already covered that administrative expenses are taken above the line for trusts to the extent that they are expenses that are incurred only because they are in trust. And if the beneficiaries had those expenses, they would have those disallowed from 2018 going forward. And Laura also mentioned about the state tax deduction. So we're going to talk a little bit more about the charitable deduction limitations, but the bottom line is that a trust can generally make charitable contribution deductions. They're more favorable than an individual. Code Section 1244 stock, this is just special stock in a co-sale business where you can take an ordinary loss if the company kind of goes out of business, and trusts are not allowed to take that. And then we'll also talk about depreciation deductions. So depreciation deductions, I think we're going to talk a little bit more about that later. But depreciation deductions can be split between the trust and the beneficiaries, and in fact, depreciation deductions sometimes get allocated directly to the beneficiaries and don't even pass through the trust. So again, there's more on that later. Slide 14, we'll compare the trust and beneficiaries rates. We'll talk about non-resident trusts escaping taxation and the effect of grantor trust status on the trust residents. So slide 15. Laura?
So when we're talking about shifting the income out to the beneficiaries, we're obviously talking about distributions, and we'd also need to consider what are the trust purposes and whether those distributions make sense or not. So some of the issues to consider would be, does a distribution make sense if you're trying to protect a beneficiary from a third party, such as a creditor, a spouse, an ex-spouse, trying to protect government benefits that they might otherwise have available to them, protecting the beneficiary from himself or herself. So we have beneficiaries who deal with addiction issues or have spendthrift problems, so we have to think about those issues. And then the last one is if we're moving assets out of a trust to a beneficiary, are we causing estate tax inclusion potentially at the beneficiary's death? Although, as noted, with the increased exemption and now greatly increased exemption, that may be less of an issue that it has been before.
And of course, that increased exemption, they've almost doubled the estate tax exemption. We don't know the official number yet, but it appears to be $11,180,000 per decedent for 2018 through, I think, the 25. So we have a temporary increase in the estate tax exemption, and who knows what's going to happen. You know, as Yogi Berra said, it's hard to predict, especially the future. And I had 3 predictions for the 1 year repeal of the estate tax, and the first one was that Dr. Kevorkian would go back into business, and that didn't happen. And the second one was the Menendez brothers would write a how-to book, and that didn't happen. And the third one was I was trying to figure out how we would have a benefit to the economy by repealing the estate tax. And I figured out that if you don't use the first 2 methods, that the third method was you could hire somebody to do your work for you. And so those people to whom you could pay some contract income, they don't report their income, and so there'd be more money circulating in the economy. And whether that prediction came true, I cannot confirm or deny that. So when we talk about the increased exemption, you know, that's a temporary measure. We don't know what's going to happen after that temporary measure, whether they will have legislation that will increase that. We also don't know whether a subsequent Congress might come in and reduce it more to the level that the Democrats had wanted.
So we may not even get to 2026. at this point if we get a same perfect storm as we had in 2017, and they could potentially reduce it to a number to what we have today or even lower potentially.
Right.
So moving on to slide 16, looking at the effects of future years, we're going to talk about the capital gain distribution elections and whether it's possible to push capital gains out to the beneficiaries, the general rule being that capital gains are typically trapped at the trust and paid at the trust level. And we're also going to talk about turning on and off grantor trust powers and potentially treating the beneficiary as a partial grantor of the trust or changing the grantor, turning a grantor trust power on. So moving on to 17. Flexibility in trust income taxation. So we can potentially look at what the standards are for distributions as well in our trust. So a support standard, which would be an ascertainable standard, and looking at our trust instrument to see whether the trustee is required to consider or ignore other resources in determining whether distribution is made. And also a welfare distribution, which is a broader standard, and potentially could have an independent trustee have that power to give more flexibility for trust distributions. And again, just looking at your living clients' estate planning documents and whether creating this flexibility could be beneficial down the road. And I think flexibility is the key to good planning and in terms of what you can do now and as tax laws change, et cetera, what you can do down the road.
Okay, our next code word is flexibility, because we want to draft flexible instruments, and we want to make sure that we do the lawyer's equivalent of the Hippocratic Oath, do no harm. And it would be really bad if you draft estate plans for your clients and the kids come to you and say, you set up this trust for mom and dad, and now we're paying all these huge income taxes, and you didn't give us the flexibility to try to cut our taxes. So slide 18. All right, so planning for excess losses, we're going to talk about that you can't pass through losses other than the depreciation. We'll talk about that you don't get the excess losses except in the final year or having net operating losses, and we also have some materials on passive loss rules. So slide 19. So our tips for fiduciary income tax return preparers that are going to consume the rest of our time here are distributions after year to carry out income to beneficiaries, capital gain elections, charitable distributions, possible change in the beneficiary's residence, material participation for business or rental activity so we can avoid the net investment income tax. Slide 20, making the trust a partial grantor trust as to a beneficiary, making the trust a complete grantor trust as to the beneficiary, trapping income in the trust notwithstanding distributions, so that kind of turns the rule we already said to you on its head, modifying the trust to make more income tax efficient. So slide 21, Laura.
So our first tip is how we as advisors can potentially help our trustees by giving them information so that they could potentially reduce their liability exposure. And under Missouri law and under the laws of many states, you can shorten the period for when a trustee can be sued if the trustee meets certain requirements, which typically would be adequately disclosing the items of the trust and giving notice to the beneficiary indicating the time allowed to commence a proceeding. And I think we're going to talk about that a little bit more down the road here too. So slide 22. So we want to point out that now, February, this is the time to be starting rough drafts of the returns, because only when you start roughing these things out can you start to compare beneficiaries' tax rates to the trust rates, et cetera, and making some of these decisions. In addition, one of the best ways to be able to carry out some of this planning is to do a 65-day distribution, and that's the reference to a distribution by March 6, 2018. And if you're able to make these distributions, you can also potentially carry out capital gains to the beneficiaries.
And when you make those distributions, you can choose to have those distributions count as 2017 distributions or 2018 distributions. And what you want to do is you want to shoot for the high side on the distributions because you might not know for sure how your return is going to wind up. And then when you actually do your return, that's how you make the election of how much is 2017 versus 2018. So slide 23, capital gain elections. So tax return preparation software will trap capital gains inside of the trust unless you take special trusts. So even if you actually made a distribution to the beneficiary, the software isn't going to carry out capital gains unless you specifically tell it to do so. And we're going to talk about strategic issues, law, and practical issues on the capital gains. So slide 24, first of all, the additional capital gain tax, that applies when the taxpayer reaches the top income tax bracket. And you can see that we have here on the slide when the top brackets are for individuals who are single, for individuals who are married filing jointly. And then if you're a trust, the top bracket is only $12,500. So you can see that this additional capital gain tax, if you can carry out capital gains to the beneficiaries, until they get to really high taxable income levels, you're probably going to save money by making distributions to the beneficiaries. Again, if it's an appropriate distribution to make. Slide 25, we also have the 3.8% tax on net investment income. And you can see at the rates of that for, again, the single person or married, $200,000 or $250,000. That didn't change by the tax law. And trust is 12.5. And the taxable income thresholds are indexed, so they will be going up over time. But as you can see, there's so much below the individual rates that, again, if you can get your net investment income out to an individual beneficiary, you may very well be able to totally avoid the net investment income tax on that income. Slide 26. Now, capital gain, actually people kind of think about the idea that you have to do something special to make your capital gain be carried out. And that actually isn't true. The statute says that capital gain is included in your DNI and therefore carried out unless it's excluded. The only thing is there's a lot of exclusions. So capital gain is excluded only if it's from the sale of a capital asset. So for example, if you have gain from a building that was used in a business, which might be more likely to appear in a K-1, then that gain is not from the sale of a capital asset because any property used in your business is not considered to be a capital asset. And so that would automatically be in DNI even though it's a capital gain. Capital gain is excluded from DNI if it's allocated to corpus, and it's actually all four of these things. It's not from it's from the sale of a capital asset. It's allocated to corpus. It's not paid, credited, or required to be distributed to the beneficiary, and it's not paid, permanently set aside, or to be used for charitable purposes. Excuse me. So slide 27. Again, why I said it's not a capital asset. If it's Code Section 1231 property, which again is gain from property used in a business, and the K-1 that the trust would receive from the business would actually call it Code Section 1231 gain. And then if it's goodwill, if you amortize the goodwill, then it's not a capital asset. If it's self-created goodwill that wasn't amortized, then it is a capital asset. Slide 28. So the mechanism for distributing capital gain, Laura's going to go through that.
So the regulation referenced at the top of slide 28 is The regulation explains when a capital gain from the sale or exchange of assets are actually included in D&I. And there's 3 instances that we're going to talk about. If it's allocated to income, allocated to corpus but distributed consistently, or the third case would be the 65-day rule distribution, allocated to corpus but actually distributed or utilized by the fiduciary in determining the amount to be distributed. So talking about the first instance, allocated to income on slide 29, when can capital gains be allocated to income? And so the power to adjust is one way that the trustee could use to be able to allow capital gain to be allocated to income. Obviously, the income beneficiaries want income and the remaindermen want growth. So the power to adjust allows the trustee to invest for total growth and allocate part of that growth out to the income beneficiary. There's a reference on here to the Uniform Principal and Income Act, which reflects the Prudent Investor Rule that's becoming part of the UFIPA. I don't know, Steve, if do you have any comments about that since you're part of that process?
Yeah, so UFIPA would liberalize the ability to the power to adjust. So right now, the power to adjust has a lot of restrictions on it, and it's not as available as it should be. I've actually heard that there's a lot of people who are just violating those restrictions and adjusting anyway, and so UFIPA would be amended to allow the power to adjust to be a little bit more liberal, and it's, I think, likely to be adopted in 2019 by the Uniform Law Commission, and then it would roll out to the various states after that. So we still have a few years probably before the power to adjust becomes more liberal. Of course, if you're drafting your documents now, you can write in your own power to adjust, and in fact, even if UFIPA becomes more liberal, our firm uses a much broader power to adjust definition, just because we really like the flexibility that it gives us in our tax planning. So,
and it is quite flexible because unlike a unitrust, which is a fixed percentage each year, you know, the power to adjust allows a fresh look basically each year, so it can be quite helpful to the trustee in determining what distributions need to be made and how those can be allocated. So slide 30, as Steve mentioned, your trust agreement itself can allow, you know, this power to adjust and could also allocate capital gain to income, although you see the regulations quoted, it cannot depart fundamentally from the traditional principles of income and principal. So we suggest a 3 to 5% range, which is sort of the range approved for unitrust. So trustees would generally be safe if they're allocating capital gains to income if the total amount of all receipts allocated to income was 5% or less.
Okay, so the next capital gain exception on slide 31 is allocated to corpus but distributed consistently. So again, you have a capital asset that got sold, it got allocated to corpus, but you've decided to always carry out capital gain to the beneficiary to the extent that you have capital gain, that you have distributions in excess of income. So this is actually when you actually make an election irrevocably on your trust return, whether you know it or not. The first time that your distributions exceed your trust accounting income, you have capital gain present, you have a choice in that year. So your choice is that we're going to always carry out capital gains or we're not going to. And as I mentioned before, tax preparation software will automatically not carry out the capital gain unless you tell it to do so. So most people have inadvertently elected not to do this, automatic carrying out of capital gain to the beneficiaries to the extent that distributions exceed trust accounting income. So we'll talk about a way to get out of it if you already if you really don't have any other good mechanism for getting the capital gain out, and it's beneficial to do so. So for a new trust, generally I would tend to allocate capital gain to D&I unless the beneficiary is in a higher federal and state combined bracket. But at the same time, I would probably rather, instead of using this exception to distribute the capital gain, I would probably rather use the exception on the next slide, slide 32. So slide 32 is if you actually distribute capital gain, then you can carry it out. So you don't have to actually trace the actual distribution. It's generally not practical to do that unless you're actually terminating the trust. Referring to the capital gain suffices. So Laura mentioned earlier the 65-day rule distribution, where we can make distributions by March 6, 2017 and carry out 2017 income. So when you make the distribution, you can say, I'm distributing $10,000 of capital gain. So the trustee can just put that in the trustee's records, and I made that decision to carry out capital gain, and that's why I made that distribution. So you just refer to it, and then that's enough. And you can be inconsistent from year to year. If one year is beneficial to carry out the capital gain and another one it isn't, then you can just decide each year whether your distribution is going to carry out the capital gain.
That gives you a lot more flexibility than the previous slide, which once you make a decision, you're locked in going forward.
Exactly.
So slide 33, just wanted to highlight some fairness issues when we think about these issues. So we typically have an upset beneficiary. If the beneficiary thinks they're going to get a distribution for a particular purpose, they receive the distribution, they spend the money, and then they ultimately get a tax bill for that. So we've suggested that the trustee may want to gross up a distribution for the beneficiary so they can use that gross up amount to pay those taxes, and also you have to consider that the gross up amount will have to pay its own share of the taxes as well. But in the end of the day, the remaindermen still may be better off by making this gross up payment because of the reduction in overall taxes that have to be paid. Slide 34, we're going to talk about whether distributions under the trust instrument are available, and the protective nature of the trust. As we've referred to earlier, there's other non-tax reasons why it may or may not be beneficial to make distributions out to a beneficiary who may have other issues. So slide 35, talking about are distributions available to be made. We talked a little bit about a support versus welfare standard. Obviously, welfare being a broader standard and allows more flexibility to the trustee, and whether or not the trustee is required to consider other resources of the beneficiary when making distributions. Slide 36, Steve.
Okay, yeah. And by the way, the consider or not consider other resources, the back of our forms generally says the trustee can consider or ignore other resources. And again, you can do it differently from one year to the next. And so you'd want to vary from that if the client really cares about, maybe this is just a source that's only supposed to be used if the beneficiary has exhausted everything else, because the grantor is really concerned about accumulating that money. So, but normally if they don't specify a preference, we like to do that, put in our forms, and so we'd suggest that you consider keeping that in your forms too. Okay, so slide 36. So we mentioned already that estate tax on the beneficiary's estate, that may have been a reason that you put it in trust to begin with, because back when the exemption was $1 million, you wanted to avoid estate tax, and now we have a higher exemption, so you don't need to avoid estate tax. So if the only reason you put it in trust is is to avoid the estate tax. Well, now maybe you don't mind having included in their estate. And one of the issues is when you have an irrevocable trust and the beneficiary dies, if that trust is not included in their estate for estate tax purposes, then they're not going to get a new basis when they die. So we do have ways you can modify a trust potentially to get it included in the beneficiary's estate. That's later on in the slides. But another thing you can do is to make a distribution in kind. So you might have stock with a value of 50 and a basis of 10. If you make a distribution of 50 of that stock, that does count as a distribution of 50. For income tax purposes, you're deemed to have only made a distribution of $10 per share. But the nice thing is that you have carried out income to the extent of that $10 per share, and when the beneficiary dies, there will be a basis step up. So it's nicer to have the basis step up than it is to have the same old basis, because same old basis would be abbreviated SOB. So slide 37, consider the protective nature of the trust. The beneficiary may have very real creditor or spousal issues, so making a distribution might save tax, but all of that money might be gone. So you distribute $100 to save $10 of tax. Well, who cares if you save the $10 of tax if that $100 goes bye-bye? So you don't want to make a distribution in certain situations, even if it's going to cost you more tax. The other is you might have a beneficiary who they don't really spend money unless they have it. And so anytime they get money, it's burning a hole in their pocket. Now, if you coach them and you have them set up an investment account and then they agree to have the distribution go to their investment account, then maybe they just don't see that distribution hitting their checkbook, and maybe they'll be willing to save. But you'd have to kind of figure out whether that would really work or not. And, of course, the other kind of beneficiary is somebody who normally saves, they're totally responsible. One day they might have creditor. The trust is more just kind of a what if, just in case they do have creditors, what if they get divorced, what if they get into a bad business deal or something like that, but they're generally responsible. So maybe saving taxes is more important to get a very real current tax benefit than it is to worry about a hypothetical creditor who might sue them down the road. So you would kind of line up beneficiaries within this spectrum and see what might make the most sense. On slide 38, we talked before about the idea that what if you make the same distributions year in and year out, and so you're not making the 65-day distribution, and that beneficiary needs that monthly check, and you're kind of stuck in that scenario number 2 that we had, where you had to have a consistent election. And when it was time to make that consistent election, you elected not to carry out capital gains. You might not even realize that you did that, but you did. And so now you're kind of stuck for that year in and year out distributions. So what might you be able to do? You might form a partnership. And what I would go with here is a limited partnership. So the trust puts the money in. The trust is a 1% general partner. The general partner is the one who controls the limited partnership. And they're a 98% limited partner. And then the beneficiary, or maybe somebody else, would be a 1% limited partner. Now, you could, if you want, have other family members invest in this limited partnership. That would be perfectly fine. But the bottom line here is that the trustee has control as a general partner, and the beneficiary is a limited partner. So slide 39, what that does is it converts the capital gain to trust accounting income. So how in the world does that work? So when you have a partnership and a trust receives partnership income, even though the partnership's K-1 will show capital gain, from a trust accounting income viewpoint, from your books and records for your fiduciary accounting income, we were talking about UFIPA before, what you count as income is what the partnership actually distributes to the trust. So let's suppose the partnership made a distribution of $50,000. The partnership had $30,000 of ordinary income and $20,000 of capital gain. Well, that whole $50,000 distribution is considered to be trust accounting income regardless of what the K-1 says. So now we have $50,000 includable in our trust accounting income, and we can choose to decide whether that $20,000 of capital gain gets distributed out, gets carried out to the beneficiaries or not. The beneficiary, the other thing is that another thing you can do here is, let's suppose you take part of the 98% limited partnership in my example, the trustee takes part of that and distributes it out. So now the beneficiary has, for example, a 2% interest in the limited partnership. So now that's that's considered to be a distribution. So again, it will carry out income and potentially capital gain to the extent of the basis in the partnership interest that got distributed. So what we've done is we've given the beneficiary this partnership interest. Now this partnership interest, as far as the beneficiary is concerned, it's limited partnership interest, it's just a piece of paper. So the beneficiary can't spend the money. So when you think about the beneficiary where money burns a hole in their pocket, if they get their partnership interest, they can't spend it. Now, what would happen, though, is if they got that 2% partnership interest, then every time the partnership makes a distribution, now it's going to be 97% to the trust and 2% to that beneficiary, plus 1% for whoever else is the partner. Or it could be that beneficiary. But the bottom line is that the beneficiary will now automatically receive the distributions that the partnership makes. However, the trustee is the general partner and can decide how much gets distributed from the partnership. So the trustee can turn on the spigot through controlling the partnership as the general partner. So we need to, if we give this distribution of this partnership interest to the beneficiary, again, it's not a piece of paper they can spend. They also can't use it to pay their federal income taxes. So you would want to gross them up, again, making cash distributions so they can pay the tax on that. Okay, the next code word is distribute, as in the trustee makes distributions, and that's what we're talking about doing here. And you would need to be, very careful, by the way, when you make your distributions, you need to input your distributions in those particular, the distributions need to be counted when you figure out your trust accounting income from your partnership, okay? So the trust doesn't the partnership software doesn't necessarily know how much is your trust accounting income from the K-1 that you got from the partnership. So you need to be careful with your software on making sure that software knows that your trust distribution income is your trust accounting income rather than what's on the K-1. Okay, slide 40, Laura.
So when we think about ideal trust distribution provisions, again, going back to what we talked about before, the key is flexibility. And there's ways that we can make our trust more flexible even when we want to exclude them from the beneficiary's estate. And we often use the term reasonable support and comfort when we talk about distributions when we have a pot trust that's a GST exempt trust and have distributions to the beneficiary's descendants, we often use this term, which is a broader term than just saying support, and indicates that it's not just used for satisfying support obligations. You also may want to consider having a 5% withdrawal right. You can even have it exercisable during a certain window of time, for example, during the 65-day period, and the trustee can even turn that off. So it gives the trustee flexibility. So if the beneficiary, for example, has creditor issues or other issues, the beneficiary, or excuse me, the trustee could potentially even turn off that withdrawal right. We could have welfare distributions as so long as we had an independent trustee in that context. So again, gives the trustee a lot more flexibility. Moving on to slide 41. We do like using welfare when appropriate because you can carry out capital gains potentially. It gives more flexibility in distributions, and also gives a trustee an opportunity to potentially decant into a new trust, and decanting is the action by the trustee to create a new trust for the benefit of the beneficiary and potentially make changes that are beneficial, and one of those might be to facilitate that estate tax inclusion that Steve was talking about previously, where it may be very beneficial to include it in the beneficiary's estate when they're not going to reach the exemption amounts, and then you get that fresh basis when they pass away, when it's included in their estate. Slide 42, we're talking about charitable distributions, and a trust charitable deduction can reduce the adjusted gross income if the charitable contribution is actually paid out of gross income. And this is the exclusive way for a charitable deduction to reduce the net investment income tax. And as we mentioned briefly previously, it's more liberal than for individuals in that a contribution made in the current year can be counted for a previous year. So if you made a contribution, if a trust made a contribution during this taxable year before December 31, 2018, it could actually count on the 2017 return as a charitable deduction. Slide 43, we wanted to highlight the fact that it's important as advisors to look for changes in the beneficiary's residence, because a change in a beneficiary's residence might change the status of whether a trust is a resident trust or a non-resident trust. And as mentioned here, states typically do not tax non-business income earned by a non-resident trust. So in Missouri, for example, a trust has to have at least one Missouri resident beneficiary to be considered a resident trust. So if you have beneficiaries that all live out of state, it would not be considered a resident trust in Missouri. And basically, it's a snapshot on the last day of each calendar year. So as you're doing tax returns each year, that's one of the things you need to take a look at. Slide 44.
Okay, so now we're getting into business income, and this is all talking about the net investment income tax. And the key on this is if you do have business income that the trust receives, the trustee needs to be materially participating in the business, and you need to document the trustee's participation. And if the trustee doesn't participate, also consider about the beneficiary's participation, and particularly if you have depreciation deductions. Some depreciation deductions can be carried out directly to the beneficiaries, and so you want the beneficiaries to participate as well as the trustee participating. Slide 45. If you have a qualified subchapter S trust, the beneficiary is taxed as a deemed owner of S corporation stock, except for the gain on the sale of stock or business assets. So the bottom line for the QSST is it's a trust that is just like a marital deduction trust in that all the income is distributed to the beneficiary, and the only person who might receive principal distributions is the beneficiary. And so the beneficiary can make an election to tax all of the K-1 income on the beneficiary's return, and then this would allow you to use the beneficiary's income tax brackets before we get into the high brackets. Then on slide 46, you can see when you talk about participation to try to avoid net investment income tax, then in a QSST you look to the beneficiary's participation and for normal operations, but when you're selling all the assets or when you're selling the stock, you look to the trustee's participation, and as well, if you have an electing small business trust, you look to the trustee, or a partnership, you look to the trustee. Slide 47, Laura.
So it's possible to make a trust a partial grantor trust as the beneficiary, and one way that the trustee could potentially do this is by exercising his or her discretion to declare a distribution, and rather than actually making a distribution, the trustee grants the beneficiary a right to withdraw the lesser of 5% or $5,000 of the trust assets. Under 678, and if there's a lapse of that withdrawal right, it makes the beneficiary a grantor as to that amount. And this portion accumulates over time, so for each year it gets greater and greater. The downside of this method is that it cannot be turned off. So this is a permanent change to the status of the trust, and the beneficiary would be a partial grantor. Slide 48.
So we can change the paradigm about all this, where the trust gets taxed unless it makes distributions, and then to the extent it makes distributions, that brings out the income to the beneficiary. So the next two sections, which we're really going to have to kind of skip over the details on them. Remember when I mentioned earlier that the QSST, the income is automatically taxed to the beneficiary. And so you don't even have to make a distribution to the beneficiary for the beneficiary to get taxed on it. And so I wrote an article that talks about when distributions are not necessarily the key, because in the QSST, the beneficiary is taxed whether or not the beneficiary receives distributions. And in an electing small business trust, the trust is taxed on the S-Corp income even if it distributes the income to the beneficiary. And the slides, basically slides 49 through 50 talk about QSSTs. Slide 51 through 54 talk about, or even 55, talk about flexible trust design. And slide 56 talks about the fact that you can toggle between a QSST and an ESBT. So there's a lot of flexibility there. But this can be some good out-of-the-box planning. So now we're going to go to slide 57 and talk about modifying the trust to make it more income tax efficient.
So even if you have an irrevocable trust, under many state laws now, under the UTC, the settlor and the beneficiaries can jointly agree to modify the provisions of the trust. So that may be one way to make the trust provisions more tax efficient. The other way, as I suggested previously, is the trustee can exercise his or her power to decant the trust, particularly if there's a welfare standard in the trust, and decant to a trust that has more beneficial provisions to give the outcome that you're looking for. Slide 58, again, we talked about how a trustee could limit his exposure time for liability by providing notice to the beneficiaries. Steve, you have an example of the notice, I believe, in your materials.
Yes.
And again, we're just pointing out that if you have beneficiaries that are litigious, it's better to get that time frame going now and change the time frame from 5 years to 1 year. And if you have a good situation, while everybody's happy, get it out and get that period of time started.
Because they might not always be happy. Things change. So slide 59, just want to wrap up by mentioning that there's over 1,500 pages of business structuring materials. I think it's up to 1,600 now.
The new tax law happened with your size, didn't it?
It sure did. It sure did. It was under 1,400 before the new tax law. Now it's over 1,500. And there's more searching functionality available there, too. And if you email me, indicate whether you want to get the my quarterly newsletter. And I encourage people to do that. And along with the quarterly newsletter, I also have a quarterly webinar that explains what's going on there, where we can do that orally. So kind of a closing thought here. So picture Snoopy, a cartoon with Snoopy, and he's sitting on top of his doghouse at his typewriter, and he's typing out a letter. Dear IRS, I am writing to you to cancel my subscription. Please remove my name from your mailing list. Now, we know that it's not so easy to do that, but I hope that with these tips that they will help you do some of that for your clients. Again, if you have any questions, you're welcome to call or email us, and the first page of the slides does include our contact information as well. Good luck with the rest of tax season and with all your planning. Look forward to catching you on the next webinar.
We thank you for joining us today.